On a quiet Friday afternoon, 3 weeks earlier, while most people were mentally clocking out and planning their weekends, a document appeared inside the Securities and Exchange Commission's electronic filing system. It was not announced on television. It did not trend on social media. There were no breaking news banners or urgent headlines. It arrived silently, the way the most important financial warnings often do. The document was a Form 13F, a legally required disclosure filed by institutional investment managers who oversee more than $100 million in assets. These filings are routine. They are considered boring. Analysts skim them, algorithms archive them, and the general public never sees them. Most 13F filings change nothing. This one changed everything. Buried inside the filing was a single detail that should have stopped the financial world cold. The Bill and Melinda Gates Foundation Trust had sold 2/3 of its Microsoft holdings in 1 quarter. This was not a minor adjustment. This was not a gradual rebalance. This was a decisive exit from a position that had defined the foundation's wealth for decades. Microsoft was not just another stock. It was the cornerstone. It was the asset that built the Gates fortune. It was the company Bill Gates understood better than almost anyone alive. And yet, quietly, methodically, without explanation, the foundation reduced its exposure by more than 50%. On its own, the move was unsettling. But when analysts began comparing this filing with dozens of other 13F disclosures submitted during the same period, something far more disturbing emerged. Across family offices, trusts, and billionaire-controlled entities, the same behavior appeared again and again. Massive stock sales, concentrated exits, identical timing. This was not coincidence. This was not diversification. This was coordination through behavior, not communication. The richest people on earth were moving in the same direction at the same time, while publicly insisting that everything was fine. And the most alarming part was not what they sold. It was how quietly they did it. This was the moment the warning began. Most people never saw it, but for those who understood what they were looking at, the message was already clear. Something was coming, and the people with the most to lose were preparing first. When ordinary investors sell stocks, the reasons are usually emotional. Fear, excitement, panic, or short-term needs drive most decisions. But billionaire selling operates under an entirely different logic. At that level of wealth, selling is rarely accidental, and it is almost never impulsive. Every move is deliberate, calculated, and informed by data that never reaches the public. This is why insider selling matters. Not because billionaires are smarter than everyone else, but because they sit closer to the center of the financial system. They see capital flows before headlines appear. They see credit stress before defaults hit the news. They feel liquidity tightening long before markets react. When they sell in isolation, it may mean nothing. When they sell together, it means everything. Historically, large-scale insider selling has preceded every major market collapse. Before the dot-com crash, executives at technology firms sold aggressively while retail investors chased internet stocks higher. Before the 2008 financial crisis, bank executives reduced exposure while publicly reassuring the public that the system was sound. In both cases, the pattern was the same. Confidence in public, caution in private. What makes the current situation more alarming is not just the volume of selling, but the concentration and timing. These are not slow exits spread over years. These are rapid liquidations executed within weeks or months. That behavior signals urgency. Urgency only exists when risk is rising faster than most people realize. Billionaires do not sell because they are bored. They do not sell because they need cash for lifestyle expenses. They sell because expected future returns no longer justify the risk they see forming. At extreme levels of wealth, preservation always comes before growth. This is why the explanation offered by financial media fails. Tax planning, philanthropy, and diversification are always present, but they do not explain synchronized behavior across unrelated individuals and industries. When dozens of the most powerful investors in the world reduce exposure to the same asset classes at the same time, the reason is systemic, not personal. Markets are forward-looking machines. Prices reflect expectations of the future, not the present. Billionaires sell when their view of the future changes. Right now, their actions suggest a future that looks far less stable than the one being sold to the public. And this was only the beginning. Numbers have a way of cutting through noise. Opinions can be dismissed, headlines can be spun. but documented financial transactions leave no room for interpretation. Between July 1, 2025 and January 15, 2026, a period of just over 6 months, billionaire insiders across multiple sectors liquidated approximately $89 billion in publicly traded stocks. This figure is not estimated. It is not rumored. It comes directly from legally required filings submitted to the United States government under penalty of perjury. At first glance, $89 billion feels abstract, almost meaningless. It is a number too large for most people to visualize. But when that figure is broken down into individual actions, its significance becomes impossible to ignore. These were not scattered sales spread evenly across time. They were concentrated exits executed with speed and precision. Jeff Bezos sold roughly $8.5 billion worth of Amazon stock in a matter of days. Not months, not years, days. Prior to recent years, Bezos had rarely sold more than a few $1 billion worth of shares in an entire year. This was not a continuation of past behavior. It was a dramatic acceleration. Mark Zuckerberg followed a similar pattern, offloading hundreds of millions of dollars in Meta shares. Jamie Dimon, the longtime chief executive of JPMorgan Chase, sold stock in the bank he has led for nearly 2 decades. It was the first time he had done so in 19 years. That single detail alone carries enormous weight. Executives with that level of access do not suddenly change behavior without reason. Individually, each sale can be explained away. Together, they form a signal. The selling was not limited to technology founders or aging executives. It appeared across finance, consumer companies, and industrial sectors. The common thread was not age, philanthropy, or personal circumstance. The common thread was timing. Markets were near all-time highs. Optimism was widespread. Public messaging remained calm. And yet, behind the scenes, those with the clearest view of the system were quietly reducing risk. $89 billion was not precaution. It was preparation. It was capital moving from exposure into safety. And history shows that when this much money moves this quickly, it is rarely early and never wrong. When the financial media discusses billionaire stock sales, the language is always reassuring. Viewers are told not to worry. These are framed as routine decisions, sensible tax planning, or generous philanthropy. On the surface, these explanations sound reasonable, but they collapse the moment timing and scale are examined together. Take Bill Gates. For years, Microsoft represented the core of his wealth and influence. Yet within a single quarter, the Gates Foundation Trust reduced its Microsoft holdings by more than half. This was not a gradual transition spread over time. It was a decisive shift away from a company that continues to dominate global technology. Microsoft did not suddenly become a bad business. The only thing that changed was the environment around it. Jeff Bezos received similar treatment from the media. His sale of $8.5 billion in Amazon stock was framed as charitable funding and long-term planning. But this explanation ignores a critical fact. Bezos compressed years' worth of selling into a handful of trading days. That kind of acceleration does not happen by accident. It happens when risk perception changes abruptly. Mark Zuckerberg's sales followed the same pattern. Hundreds of millions of dollars in Meta shares exited quietly, even as the company publicly pushed narratives of innovation, artificial intelligence, and long-term growth. Executives do not sell into strength unless they believe strength is temporary. The most revealing sale, however, came from the banking sector. Jamie Dimon's decision to sell JPMorgan Chase stock marked the first time in nearly 2 decades that he had reduced his exposure. As the leader of one of the most systemically important banks in the world, Dimon has access to real-time data on credit conditions, consumer stress, and corporate balance sheets. When someone with that level of visibility decides to sell, it is not symbolic, it is strategic. These individuals are not coordinating through meetings or phone calls. They do not need to. They are responding independently to the same signals: rising valuations, slowing growth, tightening credit, fragile confidence. Publicly, reassurance continues. Privately, exits accelerate. This gap between words and actions is where the truth lives, and right now, the actions are louder than anything being said. No investor in modern history carries more symbolic weight than Warren Buffett. For over 6 decades, he has preached patience, discipline, and long-term ownership of great businesses. His philosophy shaped generations of investors and became the moral backbone of modern capitalism, which is exactly why his recent behavior matters so much. For 3 consecutive years, Berkshire Hathaway has been a net seller of stocks. Not occasionally, not selectively, consistently. As markets climbed to new highs and enthusiasm returned, Buffett did not chase returns. He sold into strength. And instead of rotating into new opportunities, he did something far more revealing. He held cash. By the end of the third quarter of 2025, Berkshire Hathaway was sitting on more than $325 billion in cash and short-term United States Treasury bills. That number is not just large, it is unprecedented. This is capital that could have been deployed into acquisitions, private equity, or discounted equities. Buffett chose none of those options. Cash at that scale is not laziness, it is positioning. Holding cash is often criticized during bull markets because it appears unproductive. But cash has one powerful advantage that no other asset offers. Optionality. It gives its owner the ability to act when others cannot. Buffett understands market cycles better than almost anyone alive. He has lived through bubbles, crashes, panics, and recoveries. When he accumulates cash instead of buying stocks, he is signaling that prices do not yet reflect risk. When he waits, he is waiting for fear. The most important detail is not what Buffett sold, but what he did not replace it with. He reduced exposure to Apple, one of his most successful investments, even while continuing to praise the company publicly. Apple did not deteriorate, its valuation did. At elevated prices, even the best businesses become dangerous. Buffett has said repeatedly that attractive opportunities are rare in the current environment. Public markets are expensive. Private markets are expensive. Entire companies are priced for perfection. When perfection fails, valuations collapse. History behind money teaches that silence from experienced investors often speaks louder than enthusiasm from commentators. Buffett is not warning anyone directly. He does not need to. His balance sheet is the warning. $325 billion waiting patiently is not confidence. It is preparation. High valuations alone do not trigger a market adjustment. The underlying health of the companies themselves matters. For the billionaires, the most critical signal is not stock price, it is cash flow. A company can report strong revenue growth, but if it is spending more than it earns, it is creating a fragile foundation. This is exactly what is happening in today's largest tech firms. Take Microsoft, for example. Revenue growth appears healthy on the surface, rising 16% year over year in the most recent quarter. But digging deeper reveals a troubling trend. Free cash flow, the actual cash the company generates, fell by 7%. This decline is not due to poor sales. It is a result of massive capital expenditures, primarily for artificial intelligence infrastructure, data centers, GPUs, and specialized servers. The company is betting heavily that these investments will pay off, but returns are uncertain. The billionaires are watching these patterns carefully. They understand that hype-driven spending can mask underlying risk. Artificial intelligence, while promising, is still a frontier. There is no guarantee that these investments will generate profits at the scale needed to justify current valuations. If AI fails to meet expectations, the companies that have led the market, hire Microsoft, Nvidia, Amazon, will likely experience the sharpest declines. Similarly, the concentration of market value adds to the risk. 7 companies: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla now account for 32% of the S&P 500. Such concentration creates systemic vulnerability. When a few stocks dominate an index, their performance drives the entire market. If these leaders falter, the index collapses faster than most investors anticipate. History shows that the combination of high valuations, concentrated market power, and weakening cash flows is rarely sustainable. Every major correction in the past has been preceded by a similar pattern. The leading stocks stop growing as expected. Insiders reduce exposure, and the broader market eventually follows. Today, the same signals are present, and the billionaires are acting accordingly. They are shifting into defensive, cash-generating assets while reducing exposure to potential landmines. The market's strength is often an illusion. While indexes reach record highs, the reality beneath the surface is far more fragile. A critical danger today is concentration risk. When a handful of companies dominate the market's value, the system becomes highly sensitive to disruptions in those companies. Investors who fail to recognize this vulnerability are exposing themselves to catastrophic losses. Currently, 7 companies, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, represent nearly 1/3 of the S&P 500's total market capitalization. This level of concentration has not been seen since the Nifty 50 era of the 1970s, a period that ended with significant market losses for the investors who assumed these stocks were unshakable. When everyone owns the same assets, a paradox emerges. On the way up, prices are self-reinforcing. But on the way down, the impact is magnified. The mechanism of a collapse is simple. Large-scale investors or institutions begin selling to manage risk or meet obligations. Index funds, which must mirror the index's composition, then sell the largest holdings first to rebalance portfolios. This pushes prices lower, creating a feedback loop. The initial sell-off triggers further declines, forcing additional selling. In finance, this phenomenon is known as a liquidation cascade. Billionaires and institutional investors understand this dynamic. They see the structural vulnerability created by concentration. Unlike retail investors, who rely on general market sentiment and media narratives, these insiders have the knowledge and tools to anticipate how selling pressure will unfold. Their coordinated exit is not based on panic, it is strategic. It is a preemptive measure to protect wealth from a system that is primed to magnify losses when cracks appear. This is precisely why the timing of insider sales matters. Selling during euphoric markets is counterintuitive for most investors. Yet the billionaire's behavior sends a clear signal. When the leaders falter, the market as a whole will follow. History behind money emphasizes that concentration risk is not theoretical. It is real, measurable, and often underestimated until it is too late. The lesson is clear. Diversification matters, but diversification within a bubble provides little protection if the bubble itself is highly concentrated. The smart money recognizes this. And right now, they are taking action long before the masses catch on. Another crucial warning comes from credit markets. While stock prices often capture headlines, the flow of credit is the lifeblood of the modern economy. When credit conditions tighten, it is rarely obvious at first. Companies can continue to operate, but hidden pressures build beneath the surface. Billionaires, with access to detailed market intelligence, notice these pressures before the average investor does. Corporate debt in the United States has surged to 110% of GDP, exceeding levels seen before the 2008 financial crisis. During the pandemic, companies borrowed trillions at near-zero interest rates. Now, as rates rise to between 3.5 and 3.75%, debt that once cost pennies on the dollar is now 4 times more expensive. Companies that appeared profitable under low rates suddenly faced deficits. Refinancing becomes riskier, defaults increase, and the financial system begins to strain. High-yield credit spreads, which measure the risk premium for lending to lower-rated borrowers, are widening. Banks and investors are signaling concerns about default probabilities. For ordinary investors, these developments are often invisible until they impact equity prices or credit availability. But the billionaires see these trends clearly. They understand that companies struggling to refinance their debt will inevitably face forced selling, layoffs, and reduced earnings. Stocks follow these developments downward. This is why insider selling is concentrated in sectors heavily exposed to leverage. Financials, technology, and consumer discretionary sectors dominate equity portfolios, and they are precisely the areas where debt risks are building. Those who understand the mechanics of leverage know that a tightening credit market amplifies declines in asset prices. Leverage magnifies gains in rising markets, but it magnifies losses when conditions reverse. Billionaires do not rely on luck. They rely on data, historical patterns, and insight into systemic vulnerabilities. When credit spreads widen and interest costs increase, they act to reduce exposure, preserve liquidity, and prepare for opportunity. Cash becomes not just a safe harbor, becomes ammunition to acquire assets at discounted prices when the market inevitably reacts. One of the most telling indicators of an impending market shift is insider selling. Corporate insider CEOs, CFOs, board members have access to the most detailed information about their company's health, future earnings, and strategic risks. When they buy shares, it signals confidence. When they sell, it signals concern. And the data from recent months is alarming. In December 2025, the ratio of insider sales to insider purchases hit 4.7 to 1. This means that for every share insiders bought of their own companies, they sold 4.7 shares. To put this in context, this is the highest ratio recorded since 2007, right before the collapse of Lehman Brothers and the global financial crisis. History shows that such extreme levels of insider selling rarely occur without a deeper structural risk in the economy or financial markets. The implications are significant. When insiders sell at these rates, it reflects not just a desire to take profits, but an informed assessment of risk. These are the people who understand the company's cash flow, leverage, and exposure to macroeconomic pressures. Their selling is often coordinated, intentional, and strategic. Unlike retail investors who may be swayed by emotion, news, or short-term trends, insiders act based on information not widely available. This pattern is consistent across multiple sectors: technology, financials, and consumer discretionary, which have driven market gains in recent years, are experiencing the most intense insider selling. The billionaires are reducing exposure in the very areas that are most vulnerable to market corrections. They are not avoiding random stocks. They are avoiding sectors that history and data suggest are primed for trouble. History behind money emphasizes that market psychology is predictable when insiders act in concert. When executives with privileged knowledge reduce their stakes, it is a signal of caution, not panic. These actions precede declines in broader markets because the first wave of selling often triggers larger systemic reactions. Retail investors, unaware of the early signals, are typically caught off guard when the cascade begins. In short, insider selling ratios are not abstract numbers, they are a clear, measurable warning. When these ratios reach levels seen only during the lead-up to previous financial crises, the lessons from history cannot be ignored. The billionaires are speaking through their actions, and the message is unambiguous: prepare for turbulence. Among all the insiders, Bill Gates' actions are particularly instructive. The Gates Foundation trusts a massive $36.5 billion portfolio as of September 2025, has shifted its composition dramatically. Earlier in the year, Microsoft represented nearly 28.6% of the portfolio. By the end of Q3, that percentage had dropped to 12.8%, a reduction of more than half. This is not a small adjustment, it is a deliberate realignment of risk. It is important to understand that Gates is not abandoning Microsoft because it is a poorly run company. On the contrary, Microsoft is one of the best managed, most profitable technology companies on Earth. Yet Gates is reducing exposure anyway. Why? Because even the strongest companies are vulnerable when valuations reach extreme levels. At market multiples approaching 40 times earnings, the downside risk of holding these stocks increases sharply. In other words, Gates is prioritizing the protection of capital over chasing high growth. So where's the capital going? Gates is moving into Berkshire Hathaway, waste management, and Canadian National Railway investments that may seem boring compared to the glamour of tech. But they share one crucial trait: they generate stable, predictable cash flows regardless of economic conditions. Berkshire Hathaway, for instance, holds a cash pile exceeding $325 billion. This provides immense optionality, allowing the conglomerate to purchase assets at distressed prices during a market downturn. It is a defensive fortress that can exploit volatility rather than succumb to it. Waste management is another prime example. As a trash collection company with near-monopoly operations in several regions, it benefits from predictable revenue streams that are largely insulated from economic cycles. People continue producing waste regardless of whether the economy booms or contracts. Canadian National Railway, operating the only transcontinental rail network in North America, similarly generates dependable cash flow. Its services are essential to the functioning of the economy, making it recession-resistant. The lesson is clear: Gates is positioning for turbulence. While others chase growth at high multiples, he is investing in tangible assets that will withstand market shocks. This behavior highlights a fundamental principle. Wealth preservation often comes from allocating capital to assets that provide security, resilience, and flexibility, not just hype or headline-grabbing growth. Warren Buffett, widely regarded as one of the most disciplined investors in history, is demonstrating similar caution, but on an even larger scale. Berkshire Hathaway's equity portfolio, valued at $266 billion, as of September 30, 2025, has been reduced from over $350 billion at its peak. This reflects years of strategic selling, not impulsive decisions. Buffett is acting decisively, even with markets near all-time highs. One notable example is Apple. Once comprising approximately 50% of Berkshire's equity holdings, Apple's position has been reduced to about 30% in Q3 2025 alone. This is significant because Buffett has consistently praised Apple as one of the best businesses in the world. The company is profitable, innovative, and holds a loyal customer base. Yet even this high-quality stock is being sold. The reason is straightforward: valuations matter. Apple trades at around 33 times earnings, pricing in near perfection. Any disappointment in revenue, profit margins, or growth could trigger a sharp decline. Buffett's reduction in exposure is a hedge against potential market corrections. Buffett is not replacing these positions with other stocks. Instead, Berkshire is accumulating cash and treasury bills, currently exceeding $325 billion and earning approximately 5% risk-free. This is a stark contrast to conventional market advice, which often emphasizes full investment in equities for long-term growth. For Buffett, cash is not idle, it represents optionality, with substantial liquidity on hand. Berkshire can acquire undervalued assets at distressed prices when markets inevitably correct. This strategy underscores a critical principle of disciplined investing. The timing of opportunity is often unpredictable, but preparation is controllable. Buffett's approach reflects patience and strategic foresight. By holding cash and defensive assets while the broader market remains euphoric, he positions himself to capitalize on fear-driven market declines. Unlike retail investors who may react emotionally to downturns, Buffett can act rationally, acquiring high-quality assets at substantial discounts. In essence, Buffett's behavior is a clear signal to all investors. The smartest people in finance are not blindly bullish, they are preparing for turbulence. Wealth preservation and strategic positioning are priorities, even if it means temporarily sacrificing growth potential in a frothy market. Another critical macro signal that billionaire insiders are watching closely is consumer spending. The U.S. economy relies heavily on consumption, with nearly 70% of GDP driven by consumer activity. When households struggle to maintain spending, it has a ripple effect across corporate revenues, earnings, and ultimately, stock prices. Recent data indicates that American consumers are under mounting financial pressure. Credit card delinquency rates hit 6.8% in Q3 2025, the highest level since 2011. Auto loan delinquencies reached 5.6%, the highest since 2010. These are not isolated statistics. They reflect a growing inability for households to service debt. Consumers are maxed out, relying on borrowing to maintain lifestyles. When borrowing capacity is stretched, discretionary spending declines. Retail, travel, entertainment, and non-essential services all face reduced demand. Household savings rates have also dropped to 4.4%, the lowest level in decades. This decline in financial resilience leaves families vulnerable to economic shocks. With total household debt at approximately $18.59 trillion, the margin for error is thin. A sudden job loss, unexpected medical expense, or interest rate increase can push consumers into default, further reducing spending and deepening economic contraction. Insider investors recognize these patterns. They understand that a decline in consumer spending directly affects corporate earnings, particularly in sectors like technology, retail, and consumer discretionary. Stocks in these areas, which have been driving recent market highs, are highly exposed to consumer health. When the average consumer can no longer sustain spending, profits shrink, and valuations, which are currently elevated, begin to look unsustainable. The actions of billionaires, therefore, are not random. Selling equities in sectors dependent on consumer activity while reallocating capital to defensive, cash-generating assets reflects anticipation of a weakening consumer environment. While the media may reassure the public that the economy is resilient, the combination of rising delinquencies, declining savings, and heavy household debt provides a stark warning of potential market turbulence ahead. Technology, particularly artificial intelligence, AI, has been one of the most prominent drivers of market enthusiasm over the past 2 years. Companies such as Microsoft, Amazon, Google, and Meta have collectively spent over $200 billion on AI infrastructure data centers, servers, GPUs, and energy systems. The public narrative focuses on innovation and transformative potential. However, from an insider's perspective, these massive investments carry significant risk. Despite the scale of spending, the returns on these AI initiatives have not yet materialized at the level expected. Tools like ChatGPT Copilot and Gemini demonstrate impressive capabilities, but they remain far from fully profitable or scalable at corporate levels. The revenue generated so far does not yet justify the enormous capital expenditures. There is also a risk that AI may follow a path similar to previous overhyped technologies, blockchain, metaverse platforms, or speculative tech bubbles that consumed billions but delivered limited long-term financial returns. Billionaires are not waiting to see if AI will meet expectations. They are actively selling equity positions in companies highly dependent on AI hype. By doing so, they are reducing exposure to potential overvaluation while maintaining liquidity to deploy when the market reprices risk. Stocks leading the AI narrative, Nvidia, Microsoft, Amazon, have become heavily concentrated in indexes, driving valuations higher while masking fundamental weaknesses. If AI fails to generate expected profits, these high-flying stocks will likely experience the largest declines. This behavior highlights a broader principle. Insiders prioritize risk management over short-term gains. While retail investors may be caught up in the excitement of technological innovation, billionaires are evaluating the underlying economics. By selling before the bubble bursts, they protect capital and position themselves to acquire undervalued assets during the inevitable market correction. In essence, the AI hype is a litmus test for market rationality. Elevated valuations, coupled with speculative enthusiasm, create fertile ground for corrections. Insiders, with access to detailed financial and operational insights, recognize this imbalance and are acting accordingly. Their movements send a clear signal. While AI may be transformative, it is not guaranteed to generate immediate, scalable profits, and exposure to this sector carries heightened risk. Now that we have examined insider selling macro signals and sector-specific risks, it is crucial to understand the timeline of how these events may unfold and what steps you, as an investor, should take. This is not hypothetical. It is based on documented patterns and the actions of the wealthiest investors in the world. Phase 1, January through March 2026. Insider selling continues quietly. Retail investors remain optimistic. The S&P 500 stays near all-time highs, and market volatility is low. Financial media reassures the public, emphasizing the idea of a soft landing. Meanwhile, billionaires are liquidating positions, raising cash, and reducing exposure to risky assets. They understand that preparation is key, and waiting too long may eliminate the opportunity to buy undervalued assets during the next downturn. Phase 2, April through June 2026. Cracks begin to appear. A major company, perhaps Tesla, Nvidia, or Microsoft, misses earnings expectations, triggering widespread reassessment of valuations. The market begins to pull back by 5% to 10%. Volatility rises, and margin calls accelerate the downward movement. Retail investors may view this as a buying opportunity, but the insiders are not buying yet. They are waiting for a deeper correction. Phase 3, July through September 2026. The correction turns into a full-blown crash. The S&P 500 could fall 20% from its peak. Tech stocks may decline 30% to 40%. Unemployment rises, consumer spending falls, and corporate earnings collapse. The warning signs we have discussed: labor market weakness, consumer debt, commercial real estate instability, AI hype, and geopolitical risks manifest simultaneously. Insiders are sitting on cash, ready to act. Phase 4, October 2026 and beyond. Panic selling dominates, valuations are distressed, and media headlines scream crisis. Billionaires deploy their cash strategically, buying companies, defensive stocks, and other cash-generating assets at a fraction of their previous prices. The market begins its slow recovery over the next 1 to 2 years, and those who prepared can see enormous gains, while the unprepared are left recovering from losses. So, what should you do? First, assess exposure. Reduce concentration in risky assets, particularly high-tech stocks. Second, raise cash. Liquidity provides optionality to buy undervalued assets. Third, shift to defensive sectors: utilities, healthcare, waste management, railroads. Fourth, avoid leverage. Margin amplifies losses and volatility. Fifth, own physical assets: gold, silver, real estate, and cash flow generating commodities. Sixth, educate yourself. Study market history, insider behavior, and financial signals. Finally, ignore media noise. Trust the actions of those with billions on the line, not public reassurances. The message is clear. The $89 billion in insider sales over 6 months is not just a warning, it is a signal of coordinated strategic preparation for what lies ahead. The billionaires have already acted. The question is whether you will follow their lead or wait too long, exposing yourself to the collapse that insiders are preparing to profit from. The choice you make now may determine whether your financial future is secure or devastated.